And for further analysis, we are joined from London by the CEO of QW Capital, Mr. Gianluca Lobifallo. Mr. Lobifallo, welcome to the Q News Economic Bulletin. Now, given the IMF's recent upward revision to global growth forecast for 2025 and 2026, what are the key factors driving this improved outlook, and what risks could still derail the projected growth trajectory?
Yes, good evening, everybody. In reality, on the forecast of the IMF, what is really relevant is they remark that at the moment we are seeing an uploaded of the most of the countries, so kind of front running the increase of tariffs. So most of the approvisionment for the new season has been put forward by many companies. So there's been an increase in storage, simply because most companies wanted to, again, front-running the eventual increase in tariff. And so this number has been affected, but also the production over the last quarter has been affected by this front-running. Now, we have to see if we, as we expected, considering the last few days, good news on the trade deal agreement with Japan, actually a week before with UK, Japan, and Europe, and Vietnam before. So we have seen that in reality, many trade deals has been kind of settled. Assuming that nothing will change, obviously with the current US administration, we cannot rule out that there will be another opening for a new phase of negotiation. But let's assume that the deal that's been struck during the last few days hold. At least we now have certainty of what the tariff will be. If they are what they are now, frankly, is better than what people were concerned about. And we can now at least plan industrial production and trade volume and forecast what will be the impact, because we have kind of certainty at least on the tariff. If this is the case, actually, the IMF forecast that kept the rate at 3% of growth for next year, 3.1 for the following year, 2026, in reality are kind of saying that the economy is kind of stable. So it's a good news.
Yes. Well, the IMF also warned that undermining central bank independence could trigger macroeconomic instability. What are the main risks if central banks' policy decisions become subject to political influence?
Yeah, this is a disaster. We have cases in the past. The most recent one was, as everybody may remember, what happened in Turkey only 2 years ago. Clearly, Turkey is not US, and I'm sure we won't have such level of interference, but definitely central bank independence is one of the backbone of our capitalism, our financial market. So is something that we cannot even think about the implication would be. Is actually true, if we want to be very honest, over the recent path after the global financial crisis, great financial crisis, we clearly had some cases in which some central bank, particularly the Fed, was definitely not necessarily very politically independent. If I think about some period after 2012, during the Bernanke administration, it was clearly less independent than what we were expecting to. And we are paying the price now. We excess liquidity in the market, excess intervention by the Fed. And that is already kind of give a glitch of what would be a non-independent central bank.
Well, the IMF also stressed the need to protect central bank independence, not only in legal terms, but also in practice. In your opinion, what distinguishes the legal independence from practical day-to-day autonomy, and why are both necessary?
Yeah, the legal independence is a given, but you are pointing out something very important. We are not discussing here the legal independence. That is proven for example, in the US has been stated by the Federal Act that it was established in 1913. So we're not questioning the legal independence. It's the market independence, and that will imply the market credibility of central bank. Now, this is clear stated again in the Fed Act that established the Federal Reserve System, and we have to guarantee that the reason why the Fed got two mandates, or in other cases of like ECB or Bank of England or Bank of Japan, they got one mandate, is because central bank need to have a clear mandate, so that's guaranteed their independence. If they have different mandate and not very clear mandate, they would be very very inclined to be politically influenced. So when a central bank like the Fed has two mandates, has to keep the inflation in the area of the 2%, and then has to kind of support growth and financial stability, we clearly know what their target is. In the case of the Fed at the moment, the Fed is sticking with his mandate, is respecting his mandate. So whatever the administration can say, the Fed is in the at the moment, inflation is approaching 3%. According to the Fed forecast, we are going towards a 3.1% at the end of the year. And according to a very new established indicator by the Financial Times in London that is proving to be more accurate, paradoxically, than the Fed, we are actually seeing the inflation in the US, the CPI at the end of the year, to be 3.4. So with this number, the Fed has to be on hold. If anything, we should question the cut they did in September last year of 50 basis points. That was definitely not warranted. Inflation was still sustained, was not crashing. Growth was evident. So that's, to me, was a question mark. I love the Powell administration. I think it's been the best Fed run since Volcker, for sure. The only question I have is why they did this jumbo cut in September, followed by other two cuts of 25 basis points. They were not warranted.
Mr. Lo Befalo, how do heightened trade tensions and the uncertainty around tariffs complicate the job of central banks? Can political calls for rate cuts or hikes in response to such external shocks threaten the institution's ability to meet its mandate?
I mean, yes, absolutely. In a nutshell, yes. But that is one of the reasons, one of the variables that can influence inflation and growth. So now we talk about tariff, but there could be a recession, there could be a financial crisis like we had in 2008. That is the job of central bank. So this, what you are mentioning are at the moment the tension that are on the market because of policy specifically by the US administration. But bear in mind that we have to be clear, and it's becoming clear over the last few days, the tariff was not a policy, but was a tool to negotiate on their fiscal deficit and on the funding on their debt. Don't forget that they need to refund $7 trillion by the end of the year, and including the first semester of next year is $9 trillion. It's a huge amount of debt. So it's obvious that the US, the government, is trying to do anything to reduce the cost of this refinancing. That would be interest rate. But it's not. I don't think the right approach is to push the Fed to cut rates, even because the Fed would cut the short-term rates. What the US really need on refunding of the next 18 months is much more on the 5 to 10 years. And the 5 to 10 years is driven by the market, and the market expects more credibility. The more credible is the US administration, the lower the rate the market will require to buy US Treasury. So paradoxically, the more credibility the US administration will give to the Federal Reserve and to the monetary system and to the financial market, the lower the rate they will be asked to be paid. It's not putting pressure on the Fed, they will have interest rate to go down. It's actually the opposite.